Hi, everybody. Welcome to our Tobias Financial Advisors fourth quarter 2021 market update. We welcome everyone to our webcast today, and we look forward to sharing some great information with you about what happened in the prior year and what we see as some trending topics for the investment arena for 2022. Before we get started here, we just want to always remind you that this is for educational purposes. Any comments we make today are general in nature, and if you do have specific comments about your own personal financial situation, please call us at Tobias Financial Advisors, and we'll be happy to speak with you and learn more about you and your portfolio needs. Also, a little more housekeeping. On your webinar tool, there is a spot for questions, so hopefully you can understand and input any questions that you might have there, and we'll try to get to the best as we can. My name is Matt Sainholt. I am the President and Chief Investment Officer here at Tobias Financial Advisor. I am a certified financial planner and a chartered financial analyst. Chad and I both are chartered financial analysts, CFAs. We're proud of that. Great accomplishment, and there's only about 170,000 of us across the world today. So put a lot of time into that, didn't we, Chad? Welcome.
Yeah, that was a lot of fun getting the the CFA. It's a tough designation to earn. We're really proud to have it. I am Chad Neesmith. I'm the portfolio analyst here at Tobias Financial Advisors. I've been here for almost a year now at this point. I love it here, and I'm excited to share with you our insights for 2021 and going into 2022.
Okay, just a little bit about who we are. Tobias Financial Advisors is a independent advisory firm located here in Plantation, Florida, outside of Fort Lauderdale. We are now managing over $600 million of assets for our clients. That is across private individuals, company 401k plans, different types of charitable accounts and pension plans. And so we really work and try to tailor it to our clients' needs. We have a well range of advisors here, very rooted in academia and continued education. We have certified public accountants, CPA on our team. We also have CFPs, CFAs. We have a lot of designations, and we truly value our continued education and experience on our team. Briefly on a kind of a broad strokes on our investment philosophy. We really believe that you can't control what the market's doing or what the economy is doing. I mean, if anything, the past couple of years has taught us is that we just can't control what's going on outside of our environment sometimes. So we need to work with our clients to create an investment plan and policy that meets their goals and meets their needs. And how we do that is structure our portfolios along various different types of asset classes, whether that be stock or equity funds or bond, fixed income type funds, and then diversify under those as well. So we diversify broadly, US, small companies, big companies, companies headquartered abroad, and we try to focus on achieving what the investment goal is while keeping expenses and turnover low and ultimately giving you the best after-tax return that we can achieve on your behalf.
Great. Well, let's get into today's agenda. We're going to start out with a market summary, Q4 2021 market summary just for the last quarter. Then we're going to go into the full year 2021 in review. And then after that, we're going to look at 2021 asset class returns. And then we're going to take a deeper dive into some more layered in topics. First one's going to be market volatility. Second's inflation. The third is going to be international investing. Then we're looking to 2022, our outlook this year and insights we have there, and then we're going to wrap it up with some Q&A. So kicking it off, last quarter, the domestic stock market did really well, as you can see on the left side of your screen, up a little bit over 9%. That's US large cap companies, driven by really strong earnings and profitability. US earnings last year was up about 34.5%, very strong earnings growth. Mostly driven by margins coming out of the COVID-19 pandemic. International developed stocks, it's going to be Europe and a little bit of Asia, some Asian like Japan. They were up a little bit last year, or last quarter, 3.14%. they lagged a little bit in the US stock market last year. Earnings weren't as strong, but also they got a little bit cheaper than domestic stocks. And we'll talk about that later on in the presentation. Emerging markets really struggled last year compared to other asset classes, and last quarter was not a different story. A lot of the emerging markets, it's heavily weighted towards China, and the Chinese government had strong intervention in businesses, and also they had real estate issues that they were working through. But other than China, global real estate did really well in the last quarter, up a little bit over 12, and the bond markets were flat, with the U.S. bond market just up 1 basis point, 0.01%. So with that, let's go and look at the full year 2021 in the next slide. This is a really nice layout for giving you a broad idea of what 2021 did in the S&P 500. So this is just the top 500 names in the U.S. stock market. There were 252 trading days last year, with 108 down and 144 were up days. The best day you had in the U.S. stock market last year was up 2.38%, and the worst day was down 2.57%. It was relatively benign as far as volatility last year, with just a couple of small drawdowns. The biggest drawdown was down 5.12%. So it was a very not a volatile year. We hit 70 all-time highs last year, and sounds like great news. But every time you hit an all-time high, it can create some worry for some investors that, oh, this could be the top of the market, this could be it. But it just kept doing that 70 times just in 1 year. So it's really hard to time markets, and it's really hard to time the tops and the bottoms. With that many all-time highs, it's really hard to pinpoint the exact one that was it. But overall, it was just a very benign year in the markets. And then we'll go into the asset classes other than the S&P 500, the next slide. So on the far left, you can see the S&P 500 led the way, up a little bit over 28% last year. It's including dividends. The international markets were up about 15-16% in that range. The bond markets some sectors did well, some sectors underperformed or lost money last year. As you can see in the Treasury, U.S. TIPS, we had unexpected inflation. So the U.S. TIPS, Treasury inflation protected securities, were up 6% last year. High yield was up 5%. Bank loans were up a little bit over 5% as well. Those are the riskier parts of the fixed income sector. So when equities do or stocks do well, those sectors tend to do better. But if you were to put it all together, it's going to look like look at the Barclays aggregate bond, and that's going to be a collection of all bonds in the bond market. That was down collectively 1.5% last year. The dollar was also up 7%, so strong performance in the dollar last year. And commodities, just as everyone knows, did extremely well. WTI stands for oil, so oil was up 60% last year, and broad-based commodities were up 27% last year. So it was really hard to beat some of the commodities returns that we saw last year. I think we're going to pass it now to Matt to talk about market volatility in 2022.
Yeah, thanks, Chad. I mean, we had a good year performance-wise, and as Chad noted there, the U.S. stock market was up 28%, whether or not you include in dividends or not. But yeah, it was a great year. You know, GDP growth, economic growth was likely to be over 5% for 2021. We saw unemployment come down, and it was just the continued fighting and coming back from the origination of the COVID pandemic. So, you know, all this led to very positive returns in the markets. What this chart represents was, you know, we had a great year, and on the bottom here are these red numbers, and on the very far right in 2021, we can see we're up 27% for the year, but we only had the worst drawdown of the year was only -5%. Which again, it's very kind of slow and steady climb up for those positive returns. And what we're forecasting this year is a return to market volatility, where we're going to probably see some choppiness throughout the year 2022. And that doesn't mean that we're going to significantly change up our strategy. It's just going to be meaning that we're going to be looking for some opportunities when the market starts to zig and zag and possibly show us some corrections. This chart is representing back to 1979. So the past 42 years, on average, a drop in the S&P 500, the U.S. stock market, is about 14%. And so, as we said, 5% last year, but it's well below the average drop for the year. And we haven't had a correction, which is defined or as a 10% drawdown or a 10% drop in the markets. Corrections are very common. You might start seeing these this term in your news relatively soon, because already this year the S&P 500's already matched what we did as far as a drawdown last year, only within about the first 2.5 weeks of the year. Year to date 2022, the S&P 500's already down about 5%. Other markets, the NASDAQ, which is focused more on growth, is down about 8% this year, as well as some of the smaller companies in the US. And so I think our early prediction of seeing some volatility and possibly a market correction this year is on track. But we're going to look for opportunities when that does happen. And what does that mean? We look for opportunities to buy when the market's low, dollar cost average into some of these opportunities, as well as potentially from a tax perspective, look for potential losses where we can shift out of some investments for tax purposes and keep it, but still remain invested in the market overall. So that is one opportunity, or a couple of opportunities that we'll be looking for in 2022 as the market tries to kind of find itself and figure out what is going to be potentially still a positive year, but it's going to potentially be more volatile. This chart here is interesting. The best 3-year period for the US stock markets is on the left-hand side. So the 2019-2021 period has been phenomenal. Even in the midst of the COVID pandemic, it's one of the top performing best 3-year periods since 1926. And so we had a 26% return during that time frame. And then on the right-hand side of the chart, you can see the next returns in the U.S. stock markets over the next following 3 years. And you see it's variable. There's some variableness of returns. You see some negative type returns, you see some flat returns, and you still see averaging 10% a year for the next 3 years. So we all know that past performance does not guarantee future results, but I think that you can see that the range of outcomes over the next 3 years could lead to some more volatility inside the markets. So that's what we're going to be looking for, and not necessarily a cause for concern, but one of my favorite reminders for my clients is that as the stock market continues to grow, if we look at the Dow Jones 35,000 area, a 2 or 3% return drop in just one day is about 1,000 points. So you might see 1,000-point headlines, 1,000-point moves this way or that. 2 to 3% moves in the stock market, we don't love them, especially on the downside. But it is common. So we want to just prepare ourselves for some market volatility in the year ahead.
Yeah, and I think Matt, those are great points. I know that even in just these first few weeks of the year, we've done some tax loss harvesting in some portfolios, and we're going to continue to look for those opportunities this year. So there are opportunities anytime there's volatility in the market, and we're here to take advantage of those. But moving on, we're going to talk about inflation. I know it's on a lot of people's minds. We do have some nice slides for you. The first one, I think I just want to back up a little bit and talk about just the nature of inflation overall. There's really two sides of it right now. There is the short-term inflation, and then there's kind of a longer-term driving inflation. So it's kind of almost a semi-transitory state right now, where on the short end, we're looking at goods, and on the longer end, we're looking at the labor market and wage growth over time. And we're seeing signs of a tight labor market driving long-term employment through wage increases, rent increases, and keeping that cycle going for an extended period of time. But looking at the tight labor market, this kind of gives you the whole picture of it. On the top right, we can see signs of the Great Resignation, where this is the jobs labor turnover report that comes out, and we can see 4.5 million people quit in November. It's a record, it's a new record, and record job openings as well, over 10.5 million jobs that are open right now. And the bottom right, you can see that no one's getting laid off because there's no one to hire in return, and the demand for the economy is really strong. And so it's causing this really tight labor market with strong wage increases. We saw 4% wage increases last year, and we could expect that to continue in this year. Let's go on to the next slide, Matt. So that was the longer term trend in inflation. The shorter term trend is really goods spending. So as we look on the left side, we can see that the orange line represents what consumers spent on goods throughout the years. And on the yellow line is services, and then the green line is the total. As you can see, consumers, US consumers are spending a lot more on goods right now than they are on services. Part of that is supply chain issues with pricing. Part of that is just overall higher demand that we had for those goods. And on the right, you can see the suppliers' delivery times, and this is a inverted percentage of businesses that are reporting worse delivery times. So it's between 10 and 20, so it's really a little bit over 80% of firms right now are reporting slower times or deteriorating times for deliveries. And so that gives us a good idea of that the supply chain bottlenecks are still here, and they've gotten worse in 2021. We do expect that to abate a little bit this year. And it will help tamper down some of the inflationary worries going forward. I do want to note that within the goods sector, this is the first time in 50 years that durable goods have increased in price, and that is cars, furniture, appliances, and mobile homes, for example. And so mobile homes may have to do with housing increases, but durable goods, for the first time in 50 years, has shown an uptick in price in the indexes, and it's affecting both. I mean, that's a big driver of the goods side of the equation, but non-durable goods such as food and oil and clothing, those are also going up. But we're, again, expecting the supply chain to eventually taper off, supply chain issues to taper off, and to see a more moderate price in goods going forward. I think we can talk about the next slide. We're going to talk about how the yield curve looks. So this is a yield curve, and it is a representation of the yields of treasuries on different maturity dates. So if you were to look at the blue chart, for example, or the blue line on the far right, the 30-year was yielding at 2.12%. And that means that if you buy a treasury today and hold it for 30 years, you're expected to get a 2.21% return. And we can see we're looking at both absolute returns when we look at the yield curve and also the shape of the yield curve. So we can see where we are kind of in the economic cycle. And if you were to compare today to August 20th, we can see higher yields overall. And the short end has really moved a lot. So the 2 and the 3 years on the left side of your screen has come up, 1%, a little bit over 1% in that time period. And you can see the shape when you compare it between now and 2013. You can see the short end is actually higher than it was in 2013. And the curve is what they call a flatter curve, meaning that we're a little bit further along in the economic cycle than we were in 2013. But this also provides us with an opportunity because interest rates move in relation to inflation. And given that the short end of the curve is higher than it was in 2013, it's a good opportunity for us to look at the shorter end of the curve in fixed income. And one thing to note is that the longer you go out, so in the 20 and the 30 year, the more sensitive they are to interest rate movements, the prices of those bonds. So we want to kind of stay away from those longer term bonds. If they were to move up, then you could see a more drastic drawdown on your prices and it could hurt returns more. But that's one way that we would combat inflation. I do want to talk a little bit more about how we're combating inflation on the next slide. And this is just really just a visual. I know that everyone's seeing inflation in all parts of the market. At the grocery store, home prices are really high and they've gone up tremendously over the last year, and we're seeing that in rents. So that's why I included a for rent sign instead of a for sale sign, because we're seeing rents move up in the last few months. Car prices are really crazy right now, and the used car price market has gone up a lot because of the bottleneck with chip manufacturing. You may have seen some headlines about that. And then obviously we were all feeling the pain at the pump. But there are also some other areas that you may not be totally aware that are moving in prices. Hotels, we've seen a big increase in the last year. It's up a little bit over 20%, hotel prices. Electricity is up 6.5% in the last year. And then furniture is up a little bit under 12, so it's 11.8% in the last year. So if you were to buy a home, you also want to furnish the home. So I guess it all kind of is in a big cycle right now, but we are looking to fight inflation in our portfolios and really mitigate that risk for clients. We do that in several areas, but the first one is a diversified stock portfolio. So if you were to invest in a diversified portfolio where, let's say you have Coca-Cola, you're able to pass along that inflation cost to the consumer over time. And that's probably the best way to fight inflation in the long term, is through good quality stocks in your portfolio. The second area is commodities exposure. So we're buying a broad, diversified bucket of commodities to fight the raw goods increases over time. And then, as we talked earlier, the short duration fixed income, that's another spot that we are looking at where we are being defensive in fighting inflation. We're expecting interest rates to move up over time, so we want to be defensive in that area of the portfolios. And I think with that, we're going to go possibly back to Matt to discuss international investing.
Yes, thanks, Chad. So in a period or time frame of low interest rates and the U.S. market doing really well the past few years, we need to kind of look across the globe for different opportunities that present themselves in the stock markets around the world. In this inflationary environment, this is another opportunity to be in a stock portfolio, as Chad just mentioned, where the company can pass on some of the inflationary costs onto the end consumer and still be profitable. What we're looking at here is a chart comparing the U.S. stock market to the rest of the world, and it's comparing the price. So when the price of the United States stock market is doing well, this chart is going up. You can see from about the trial of about 2009 was the bottom of when kind of the last time, maybe the early 2000s, when the line is going down. That means international stocks are beating the United States stock market. So, in the past 10, 12 years, the United States have done really well, and the rest of the world may be time for them to catch up. And so when we look at how the U.S. has done, we just kind of want to compare that to the rest of the world as well. Some stocks, some companies that are located abroad that I'm sure you see basically every day would be like Toyota, Nestle at the grocery store, Samsung at your electronics store or appliance store even. These companies, if you're not thinking about investing broadly, investing globally, these companies wouldn't be in your portfolio, and yet we see them on a day-to-day basis. So the U.S. has done really well the past decade or so, and now when we think about what's on sale or what is the place where we might be able to find a good deal on certain companies around the globe, what we're looking at here, there's a lot going on here. My statistical friends out there, you'll love to see these standard deviations, but basically from how we value certain companies by looking at their price of the stock versus how much that company earns. Typically between the U.S. versus international companies, there is a negative, about 13%. And right now there's a big discrepancy. And what basically, in short, this means that when you're looking at valuations and pricing, international companies are on sale or better priced than U.S. companies. And kind of on the same side of the coin here, on this right side here, is dividend yields. Again, in a period of low interest rates, we're looking anywhere and everywhere in our portfolios for income and dividends. Again, this is kind of out of the norm where the international companies are paying a higher dividend than traditionally versus the stocks here and companies here in the U.S. So in summary, it's the U.S. has had a tremendous run, and when we're looking out across the landscape, we see a good valuations, good entry points into U.S. or into international companies. Kind of like, I guess it's football season here. It's kind of like the Super Bowl. Tom Brady has done very well here for the past many years. We're not going to give up on the rest of the league, we're going to continue to look for teams that might have been have some promise and may not be still at the top. As we know, things change and ebb and flow throughout the NFL, as well as economies of the markets worldwide. Chad?
Well, Matt, thanks for making me feel good about my Falcons this year. Well, maybe this will be the year for the Atlanta Falcons. We're talking a little bit about 2022, outlook and insights, what we see, and this is points of optimism. I know that we're all feeling the biggest Omicron wave right now. We have so many new cases and it's so easily transmittable, but it's expected to be the only major wave of the year. And really after it kind of goes through, a lot of people are going to have protections from the virus through vaccination or prior infection. So that's really good for our economy as we continue to reopen the economy. And we are also expecting above trend GDP growth because of that. Consensus is somewhere around 3.5–4% this year. And that's above the average that we've had over the last 20 years. And so we're expecting to be strong economically. The economy's almost at full employment already at 3.9% unemployment rate. And that number is expected to probably stay around that area as we get late in the cycles. People re-enter the workforce, and we're probably expecting more people to re-enter the workforce to find jobs going forward. So we think that that's a really good sign for employment and for our economy. And we think that the strong economy is going to cause rising interest rates, and that's indicative of, that's a sign that we're going to have a strong economy this year. So those are all things to look for on the positive side. Optimistically for 2022.
And what about some concerns, Chad?
Well, the concerns, the caution. The economy is still fighting those supply chain bottlenecks we talked about earlier. It goes into inflation. It's something we expect again to abate a little bit this year, but it's hard to predict. And then inflation is going to feed through to portfolios and purchasing power, so you can continue to see those higher prices going forward, but at a slower rate of growth. So we think that a lot of the inflation has been realized, but it'll continue puttering along this year and next year. But some companies, you're seeing it in earnings. In this S&P 500, we've had some earnings report come out recently where they're seeing labor costs increasing as they're trying to retain their employees. And this is feeding into margins and feeding into earnings. We're seeing that across the board in banking, in retail, and airlines. Healthcare companies are also mentioning that, so we're seeing it in all different industries and not just one specific industry right now. So it's something we're keeping a close eye on as we go into this earnings season, and we'll listen to some more calls and keep track of that for you.
So as we kind of put it all together here, one of the things we stand behind and believe in is a diversified portfolio. And Chad, if you could walk us through what the portfolio does for you.
Absolutely. So this is a chart that shows the last 21 odd years of returns, and it compares the S&P 500 through a diversified portfolio over time. And so the diversified portfolio is going to have advantages such as rebalancing, some tax benefits over just investing in the S&P 500, maybe some tax loss harvesting that we spoke about. So when you were to compare, I know the S&P 500 has done really well over the last 10 years, but if you were to compare it over the last 20, we've gone through many cycles. As you can see, it's a bumpier ride on the left side if you were just to invest solely in the S&P 500. The diversified portfolio on the right side, at the very bottom, you can see it's gotten you to about the same spot, about the same return over time, but it's a lot less bumpy of a ride. And I know that sometimes you may lose money and think that oh my gosh, how did that happen? We lost money. In the S&P 500, generally you would lose more. So in diversified portfolio, it keeps returns just tighter and more consistent, and it helps your planners and us plan for your retirement much easier, and it makes your retirement more realistic and your goals more realistic, and it provides you with a greater peace of mind so you can live your life, hopefully not have your eyes glued to the markets every day. Let us do that. We like it. We don't want to stress you out, but just overall diversified portfolio works over time, and it's a great asset for us.
Absolutely, Chad, and that is something that we do for our clients every day. And if you're not a client at this point in time and you'd like us to take a look at your portfolio and how you're positioned, we do a complimentary portfolio review that anyone inquires or asks us to do, and we'd be happy to kind of sit with you and walk through how you're positioned in order for your portfolio to help you meet your goals. As we kind of wrap up today here, we do have one question coming in about the Fed potentially increasing interest rates. Chad, can you just kind of walk us through and kind of think about what is the Fed weighing when they feel and consider increasing the interest rate? What are they thinking about?
Yeah. So the Fed has a dual mandate. They look at inflation and they look at the labor markets, and they're trying to balance stable prices and a full, or I guess what am I thinking of? Like just a full labor market where everyone's fully employed. And so it's really difficult in this environment to predict how things are going to go because COVID shut the economy down so quickly and things have recovered so quickly. So the Fed is looking to raise interest rates to battle inflation coming out of the recession. Generally, when you're coming out of recession, you see some inflationary pressures, and the Fed raises interest rates to combat that. They are predicting that they're going to raise it. Actually, the market's thinking about 4 times next year, and so that'll help with the inflationary cycle, and it won't hurt the employment picture that much because the labor markets are so strong right now. So that's what they're having their eye on right now, is both inflation and labor markets, and they're looking to not slow the economy down, but really they're a buffer to make the recessions not as bad and they make the booms not as big to keep the economy overall in a stable situation.
A very tough balancing act, and we will definitely keep a pulse on potential interest rate increases throughout the year. And that is one thing that I'm sure we'll be visiting on our next webinar and next time we speak to you. So we thank you for your time. Thank you for joining us today. Please do reach out to us with any questions or comments you may have regarding today's presentation or anything you might be seeing in the news cycle about investments and how it may affect you and your financial plan. Thank you, and till next time.
Thank you so much, everyone.